Hello, everyone. I have some rather big news for Forward Guidance listeners. This will actually be one of the final Forward Guidance episodes that I'll be hosting. The extremely talented Felix Javine will be taking over Forward Guidance very shortly, and I'll be leaving to host a new podcast called Monetary Matters. You can subscribe to the Monetary Matters YouTube channel right here, and the Monetary Matters podcast channel will be set up very shortly. And of course, you can stay up to date with my work by following me on Twitter at JackVarley96. Thanks, and let's get into today's interview. I'm very excited to welcome to Forward Guidance Brett Jefferson, founder and co-chief investment officer of Hildene Capital Management, a fund with around $14 billion of assets under management, focusing on structured credit, opportunistic credit, and private credit. Welcome. Good to see you, Brett.
Thank you, Jack. Pleasure to be speaking with you today.
Brett, as you know, and as some of the audience may know, this is my final episode of Forward Guidance. So somewhat emotional one for me, but I'm really excited that I'll be going out strong because this is going to be a very, very special interview. I want to focus on an asset class that before I had heard of you, I'd never even heard of this asset class. And it's an asset class that I understand you've been very involved in and have been and continue to be one of the biggest players in this asset class. And that asset class is known as the trust preferred collateralized debt obligation or trust preferred CDO. So let's just get started. And Hildene Capital Management, your firm, invests in a series of other products and structured credit and types of credit that are not trust preferred CDOs. But is my understanding, this has been your bread and butter. So first, let's start off. What is a trust preferred CDO, and when did you first hear about it?
Sure. So let's start with the market of securitization. Securitizations take assets that were created, and they form a vehicle to finance them in a better way. They basically create standalone finance companies, whether that's with mortgages, whether that's with loans, whether that's with asset-backed securities, consumer receivables, or whether that's with trust preferreds. And a trust preferred is something that they can't create any more of them. They were basically regulated out after the financial crisis, but they're issued by banks and insurance companies. And basically in the mid-'80s, they came up with a security which they said 25% of a bank's tier one capital. So tier one capital is equity. And let's just say that banks, for the most part, had to have 10% in tier one capital. And 25% of a bank's tier one capital could be in this form of debt. And there were two caveats about this debt. One was it had to be deferrable for up to 5 years, meaning you didn't have to defer, and most people would never want to defer. But if you did miss payments, you could do so for up to 5 years before you went into default, which is much not like other debt securities. And the other is it had to be issued as a 30-year security, but you could call them, really at any time after you had issued them, but they had to be issued as long dated. And the reason that was the regulators didn't want the banks to be under pressure. They wanted them, if they had problems, that they could work themselves out of it. But if you think about it, if you were a $1 billion bank, which is a small bank, and you had $100 million of tier one capital, which would be 10%, you could issue 25% of your tier one capital in a trust preferred. When this product first came out, the cities, the B of A's, the Wells Fargo's issued as much as they possibly could. But then the small regional investment banks, such as First Tennessee, KBW, Sandler O'Neill, went out and started to underwrite all these smaller banks and issue trust preferreds. But instead of issuing $25 million of a trust preferred to the market, they pooled them and securitized them. And there were 8,000 banks in the country in 2008 as the crisis started. So what happened was there were 91 of these securitizations. These trust preferreds were issued into these securitizations. There wasn't that much overlap amongst deals, meaning different trust preferreds. But the one thing that jumped out to me, so you said, trust preferreds were my bread and butter. I'm a securitization, let's just say, I'll call myself an expert in securitizations.
Yeah,
and
you are.
What I do is we understand, what are the assets, what is the structure, and what is the option. We'll touch on that in a little bit later, but that's really the bread and butter to looking at any securitization. But in 2008, I decided to start Hildene. I didn't have a lot of money to invest, and everyone else was looking at subprime mortgages, Alt-A mortgages, CLOs, very, very large pools of assets, which also didn't hang around that long. And I went out and found all the information I could on the trust preferred CDO market, which was basically, finding out the information on the banks. What I also started to realize that the way that these deals were put together is if a trust preferred started to defer, it was written down to zero. So if you think about it, if you're an asset in a CLO, you're a leverage loan, and you default, okay, you have defaulted. So now you're written down usually to the lower of the market value or 45 cents of the dollar. So if you're trading at 55, they say you're at 45 cents of the dollar. With the trust preferred, if you were deferring, you were counted as a defaulted security and you were written down to zero or maybe 5% in some deals. But what we found out was that these banks weren't deferring because they were having problems. They were deferring because the regulators were telling them to, because the regulators were overwhelmed. So as people look at securitizations that have had problems, if you look at a CLO and you say, this many names have defaulted, hence how many more will default, if the CLO is going through some form of a crisis like in 2008. With the trust preferreds, you were looking at the pool and saying, this many of the trust preferreds were deferring or defaulted, okay? But most of those deferrals came back. So it wasn't actually looking at it and saying there's going to be this many more that are going to fail. It was there's going to be so many of these are going to actually recover, which was unlike any other type of distress situation, really in structured products. But that's really trust preferreds in a nutshell.
CDO, a collateralized debt obligation, is just a wrapper. You could put anything in a collateralized debt obligation. So, people who've seen The Big Short think of CDOs that the underlying asset is subprime mortgage-backed securities, which are made up of, at the time, low-quality mortgages. And so that is the assets in the CDO. The liabilities that are issued are what other people own, and those investors got totally hosed in 2008, and that's part of what caused and led to the great financial crisis and the subsequent recession. And so a trust preferred security is a type of equity that a bank can issue. You said in the 1980s, so 1990s. I think during that that deregulatory time, where a lot of risk began to become allowed, that accumulated, that ultimately led to the great financial crisis, in my opinion. They said this part of equity that protects depositors, it protects the financial system. Let's have a loophole where basically they can issue a debt that will treat it as equity. And so that's a problem. And then you say the Wells Fargo, the Bank of America, they issue that. Okay. But then smaller banks began to issue it, but there wasn't a sufficient market. Who's going to be buying this stuff? So they package it into a CDO, and then that's how they sold it. And interestingly, according to a paper from the Philadelphia Federal Reserve, that was in 2011, so after the great financial crisis, a lot of banks owned the paper too. So in the CDO was bank debt that was kind of phantom equity, or masquerading as equity, even though it was allowed by the regulations. And then a lot of those liabilities were themselves owned by the banks. So you can see what it kind of leads to the great financial crisis. But as someone who's study the great financial crisis, I had no idea these things even existed. So this is I'm glad that we're doing this, because I assume a lot of people, most of our audience, even if they consider themselves financial autodidacts or even financial experts in one part of the field, they likely will not have heard of this either. Brett, you founded your firm in 2008. When?
Sure.
Because March is when Bear Stearns failed. September was when Lehman Brothers failed. When did you found that? Because depending on what month you started it, security prices were either at 95 cents or 85 cents or 35 cents.
It's kind of funny. We when do you start a firm? So you decide you're going to start a firm, and there's a lot of things you got to do. We actually, incorporated or filled out our documents in 2007, sort of went out, and I was the first investor, and then started to buy things in May of 2008. And I for the first 6 months, I was finding different types of securities, and I was looking at mortgages, I was looking at CLOs, but then I started really buying trust preferred CDOs. Probably the first one was in the later part of 2008, and I think the bigger part of it was that there had been so many write downs. When you say write downs, because of the accounting in the CDO, because of the deferrals, and because of the defaults. And look, I'm not saying that there weren't problems in the banking sector. There absolutely were. What I'm saying is that I was investing in an asset class where the perceived amount of loss was much less than what was being shown because of the way that they were accounting for these. The bonds started to pick, meaning you breach a coverage test in a CDO, you stop paying interest. Yes, I'm not saying that the way trust preferreds were sold and sold to small banks was a smart thing to do. That's not what I'm here to do. That's not what I do. I'm here to find good opportunities. So as they started to come out in small bite sizes, $2 million pieces, and I'm buying them at less than 10 cents on the dollar, B notes, second priority notes, I was looking at these and saying, my downside is if I just paid 7. My upside is I get par and all my money back. And those were pretty good odds, and I took those odds.
What was the bottom in trust preferred CDO liabilities? The bottom in the stock market was March 2009. What was the bottom of, if there was some index, I don't know if there is, of the trust preferred, and what was how many cents on the dollar were they trading at?
No, there's no index, even though I used to joke that there was a TruPS index. And of course, I was the one who had it. Look, I bought, depending on the deal, I bought bonds for 1 cent on the dollar. And I bought bonds for 1 cent on the dollar that have paid off all interest and principal. And
so that's a return of 100 times.
No, 150.
Why? Why 150?
Because you're getting interest and you're getting back due interest.
Okay.
So you paid 1 cent. You paid 1% of 100, and it maybe owed you 10 points of back due interest. Didn't pay you for 4 years, so you picked up, call it 20 more points of back due interest, and then the bond's been called away. I've bought residual tranches for $5,000 that have paid me 30, 40 cents on the dollar. So 5,000 per million. So,
wow.
And it's not just one or two, hundreds. I didn't buy them all there. I was buying them for cents, and then I was buying them in the teens, then I was buying them in the 20s, and now we buy them in the 70s because they're going to pay off. And one of the important things to note about structured products is that as you breach your coverage test, okay, so you breach a test and you trap all the interest. So think of that as you have two companies. You have one company that is going to pay a dividend, and you have one company that's going to retain all of its money and pay down its debt. Okay, so those are two companies. And the second one is a trust preferred that is breaching its coverage test, meaning you're breaching that lowest coverage test. Every single excess dollar is going to pay down excess spread. And a CLO is, we'll call it a 7-year instrument. So if you start to have problems after 3 or 4 years, you're trapping that cash for, let's just say, 4 more years. Okay. Trust preferred started to have problems, we'll call it 5 years after existence. They're going to stay around, a lot of them, for 30 years. They're going to trap cash for 20 to 25 years. So that value that's in the system is hugely valuable. And that's unlike any other structured products trade that's ever occurred.
All right, just trying to wrap my head around what you're saying. And yeah, just because when you say 150 times, that's not 150%. It's 150 times.
Yes.
So the liabilities, you bought that, let's just say you bought a liability at 10 cents and the payments into that pool were deferred. Why? Because it broke some type of coverage ratio. Tell us about that and explain why it matters.
Sure. Every CDO has something called an over-collateralization test. And it's basically measured by the amount of performing assets divided by the debt. And you have a senior test. And if you have support, like if you have 5 different tranches in a CLO, you might have 5 different coverage tests. Let's make it easy. And we'll say we have one test. Okay. So we have an A bond, a B bond, and equity. And that senior test was originally struck at 120. Okay. So you needed to have 1.2 times of over collateralization, or else you're breaching that test. And let's just say within the world of the banks that were in here, 25% failed. Okay. So 25% failed. And you went down to, so you started, let's just say at 145 and you went down to 120. But then you had 15% deferred. You write those down. So now you're in the hole. You're 105. And as you breach that test, you pay your A notes. Okay. And then all the excess spread, all the excess interest that's left over goes to pay down the A notes. So it's called a waterfall. Comes down, fails that test, goes and pays it down. Well, If you're failing that test for 15 years, okay, you're building up a lot of value. And that's why this is, we were playing the long game with this because we were buying these things so cheap. And now we found a great place for them.
You were buying the lower rated tranches.
I wasn't buying the senior. So think about it. Trust preferreds, they usually were like an A1 and an A2, which were rated AAA. Those were sold usually into the neg basis back in 2008. So they were sold and funded in either a derivative form or sold to a bank. Then you had, your Bs and your Cs. So the deals were either A, B, then they were A1, A2, B, C. Then some of the later ones went B, C, D. So there are different tranches with different tests. At first, I was buying Bs, okay? And I was buying Bs cheap. And then when the Bs got up, then I was buying Cs. Then I was buying Ds. And every once in a while, somebody would come and they'd say, like, I've got some equity for sale. And, they say, I'll pay you $5,000 per million. You'd be like, okay, that's a good option. And when you're doing this, a lot of times you're realizing that either the holder of this can't hold it. So if you're a bank and all of a sudden this original bond that was a second priority B bond was an A rated bond, and now it's a single B bond, they can't hold that. They have to get rid of it. And
because of ratings, because capital weightings, they say it's a very risky asset because it has a lower rating. So you have to hold a lot of capital against it. So they don't want to do that.
Insurance companies, that they have all kinds of different capital levels they have to hold against it. They're ratings type buyers. With the equity, a lot of times, or with some of the much lower bonds, people wanted to take a tax loss. So if you basically have a bond that's you bought for 100 and somebody's saying, I'll pay you 2 cents on the dollar for it, you could write it down to 2 cents on the dollar, but you can't take a loss unless you sell it, right? So people are like, well, for tax reasons, I think this thing's worthless. Why don't I sell it and take a 98-cent write down, which is good for taxes? It's a tax write-off. And there was a lot of that. There was definitely a lot of that.
And so let's talk about the underlying assets that is in the structure. They are bank loans that are senior to equity but junior to other stuff, and basically their financial health and whether they're getting paid depends upon the health of the underlying banks, most probably regional banks.
You got we'll call it a big bank like Citigroup. So Citigroup has deposits, okay? Then they may have subordinated debt, which is issued from the bank, and then they have a holding company. In the holding company, they may issue preferred stock, okay? And then they may issue trust preferreds. Trust preferreds would have been senior to the preferred stock, okay? So preferred stock is counted as equity, okay? And that's tier 2 capital. But your subordinated debt would have been senior to the trust preferred. Most of these banks that went in here were private banks, or what we'll call quasi-private, meaning they may have been public, but the stock just didn't trade. And they had deposits, and they had equity, and then they issued a trust preferred. And these trust preferreds didn't trade anywhere. They were just in these deals. And it's senior to the equity. So yes, it is senior to the equity. If they had preferred stock, it would be senior to them. Problem is most of the time when banks fail, there's not much left over. Okay. And yeah, there was a lot of bad things that were going on in pre-2008. But where we are now is, so we're focused on, a couple different asset classes, but two that we're really focused on are ones where you can say, when you have the biggest problem in the mortgage space in the history of money, and you have the biggest problem in the banking space in the history of money, these two asset classes are going to be regulated. Right? It's like I was explaining it to my niece. She went to college. I go, this is like, remember that Project X, that movie Project X? That kid.
Yep.
Yeah, he got grounded. Okay, here are the new rules. Okay, so banks now are highly regulated. Hence, why do you have such a large private credit market? Because banks can't lend. So banks can't lend. So now I own debt of banks, which did bad stuff, pre-2008 and can't do anything. Now I'm not buying their equity, so I don't know if their equity is going to go up that much, but I feel pretty good about the debt of the bank. We also buy non-QM mortgages. These are not subprime mortgages. These are for non-qualified buyers, people who are self-employed, maybe a second home. They are 70 loan to value. If you have gotten a mortgage lately, or you know anyone who's gotten a mortgage, ask them how many different forms, how many different appraisals, how many different things they have to do to get a mortgage. It is not just signing up and making sure you have a heartbeat. Now you're going to give you money. Okay. It is much different. And if you lie on your mortgage application, you have big problems. So there's a lot less leverage now in the mortgage space. We like this asset class. And I'm fine holding the debt of banks right now and watching this asset class as it's going to go. Now, trust preferreds were regulated out. Okay. It was something called the Collins Amendment. And they basically said these trust preferreds, these were bad. Never should have happened. Everyone has great hindsight. Trust preferred should have never happened. But what they did say is they said small banks can have it because we don't want them to be forced to go out and raise capital right now. So if you're less than $15 billion, which is a lot of this universe, okay, you are grandfathered on your trust preferred. So that means that we still have a lot of assets left, but it also allows us to really understand the callability, what's going to happen. And we think that a lot of these banks are going to get out of these 5 years before, starting 5 years before the maturity. Because why would you want to get rid of this? It's cheap funding and you're getting tier one capital treatment for it. Why would you want to do that? So they still are around, but they're not coming back anymore.
And no new ones are being issued.
No new ones are being issued.
Got it. So it's kind of like a bearer bond where they're not new ones are being issued, but they still exist.
They still exist because it's still an obligation. It's still a contractual obligation. Just you can't issue one of these and get the regulatory treatment that you did. Banks can issue debt, and they're issuing sub-debt, and the sub-debt market is large, and most people who take out their trust preferreds do it with the sub-debt market. But you don't get that tier one capital treatment. We've done two sub-debt securitizations where we buy sub-debt and we securitize.
Where's the market trading now? And do you have the element of being pulled to par where, you buy a 30-year, like zero coupon treasury bond, you buy it at 70 cents, but every, month it goes up 70, 71, just because you're getting closer and closer to that date. And for this, it's not just the duration fact, but it's also the credit risk.
Yeah. Well, it's not an actively traded market because a lot of it, we own. We own a lot of the mezzanine bonds, which we feel have very good optionality. When I say optionality, I'm going to just throw something conceptually out there for you. So these bonds can be auction called. Okay. So you can call these bonds. They were set up as a 30-year security. And after 10 years, they would have auction calls. So if you think about it, if when you have an auction call, you come in, you buy all the assets, but you have to pay off all the debt. But if I own, let's just say there's an A tranche and a B tranche, and I own all the B bonds. I own them at 60 cents on the dollar, right? And they're all in one pocket. And all the bonds, I'm going to go in, I'm going to buy all the assets from that securitization. All I have to do is make sure that my net charge is 61, right? Because I own them. I own them all. So by doing that, we have a huge competitive advantage because we have broken 12 of these deals and then re-securitize them. So we buy the assets and then we do another securitization and we get better funding. However, there's not that many of them left, but we feel strongly that the vast majority of the things that we own are going to pay par or pretty close to par. And I know the gentleman who wrote the Philadelphia Fed paper back in 2011, and I challenged him 10 times to come and debate me about that paper. And I'm willing to show him my returns and willing to show my analysis. So somebody goes and writes a paper like that. What was his name again? I forget his name. But somebody goes and writes a paper like that. And then
Larry Cordell, Michael Hopkins, and Yilin Huang.
Sure. Anytime they want to sit down and talk about how their paper is one of the biggest, bits of gibberish I've ever read, I'm happy to tell them that. I'm happy to tell them that and prove that it is. Because we've done pretty well with these. Okay. And we haven't had a lot of banks fail recently.
Okay. So I didn't know that you were familiar with or even had this reaction to this paper. I guess I should be surprised because it's such a small market. But yeah, I mean, I read this in order to educate myself about the asset class because I literally had never heard about it, but before you and I got in touch. That's very interesting that you disagree with its conclusion. So yeah, I mean, it was written in 2011. So everything in that paper, it was about before 2011. I, read the first half of it, which, I really wanted to understand the history of it. And then I thought that, I could get the, 2009 onwards, that could be part of our discussion. But so what were the conclusions from that paper that you think are gibberish? This is very interesting.
Well, he was basically saying that none of the senior bonds were going to pay off par. I mean, he was basically saying there was going to be so many failures in the banking sector that none of the senior bonds were going to pay off at par. Now, I'm not disagreeing with them that, look, should the trust preferreds ever been created? I don't know. That's not what I'm here to talk about. I'm here to talk about I bought something and I had a view that it was going to pay me a lot more than what I paid for it. Now, we have had many, many deals, and I could give you the exact name where all of the debt has been paid off, not just the A's, but all the way down to the D's. Okay. And, that's really the gist of it. He was saying there's going to be excessive losses in this asset class, which not a lot of people follow or look at. And yeah, it's me and maybe two other people really look at it. But, it's done exceptionally well because of where it was. I mean, I don't think, people used to talk about Russian bonds being the greatest trade of all time. You could have bought Russian bonds at 5 cents on the dollar. I bought hundreds and hundreds of bonds, less than 10 cents on the dollar, that will pay off at par. Hundreds of less than 20 cents on the dollar. So that's really never happened before. So yeah, it's good. It's not, I'm by no means a bank expert. I can tell you that. Because we're really in the death business. We're looking at these underlying banks and we're saying, I don't really care what your stock does. Are you going to live or die? Are you going to live or die? Because that's it. Because if not, you're in the securitization. You're not getting out at a discount. And someday you're going to have to pay me off. And I've had to go to court many times to make sure that has been enforced.
Interesting. So what is in the paper that you disagree with is the assumption that these deals would go bad and wouldn't be paid off. I wonder if there is some.
These deals did go bad. Don't get me wrong. There are failures in the banking space. What he was saying is the senior bonds, okay, the amount of losses that it would have taken to have a loss on the senior bonds, okay, would have, because you had 8,000 banks, to get losses up to the senior part of the capital structure, if you took that across all the different banks, you would have had probably 4,000 banks fail, okay? There were about 500 banks fail, okay?
I wonder, a point of potential agreement is in 2011, he was talking about how badly it went. And they definitely talk about that. There's three co-authors. And yeah, if banks who bought them at 100 cents on the dollar wrote them down to 5 cents. So I think they were capturing that immense pain. And that's why you had a chance to have a 20 times return, or in that, other instance, the 150 times return of you buy it for 1 cent. So the losses of 2007, 2008 is why you were able to have those great returns, right?
Look, I understand there's people out there who talk about efficient markets, right? They believe that markets are efficient. I believe that markets are not efficient. I believe that you can find inefficiencies, and I like to be in inefficient markets. Structured products, CLOs, trust preferred CDOs, mortgage bonds that have a credit component. These are still inefficient because they have three things. They have value of the assets, value of the structure, value of the option. And because you have those three different things, and because they're small, unique, self-governed companies, which is kind of an interesting, unique thing about these, you will have inefficiencies within this asset class. If you look at other asset classes, like how many equity sales traders are left? Really none, because computers can do it better. High yield bond salesmen used to get paid a fortune because they had to move bonds. Now people, it's a whole different world. And, when you really look at different assets, well, the one that used to be the most inefficient were convertible bonds, because you had two components. You had a bond and you had an option. It's not as inefficient market as it used to be. We like to traffic in things that have inefficiencies. People talk about finding inefficiencies. We are in an inefficient market. It is, because if a market can move, okay, 98% lower, and I can buy it and it can pay me off, then that's inefficient. And when you have a problem like you had in COVID, look at what asset class moved the most. Look at what happened to the CLO market.
Yep.
Look at what happened to other structured product markets, mortgage markets, things like that. I mean, these are still inefficient asset classes.
Right. And there are a lot of people who are paid a lot of money to try and determine which is a better investment, Coca-Cola or Pepsi, or Apple versus Microsoft. And there are not as many people who are buying the liabilities of trust preferred CDOs at pennies on the dollar. So I see what you're saying. You got to go where the inefficiency is. That's where the alpha is.
Well, let's be clear about this. We're buying structured products. And most of the people who buy structured products, a lot of them were insurance companies. Okay. we have started an insurance company. We've started a reinsurance company, and we'll get into that in a little bit. But a lot of the people who were buying structured products on the we'll call it on the mezzanine part of the capital structure, not the residual tranches, they were buying them, were putting them away. Then they have a problem, and they have to get rid of them. Okay, I'm not going to knock them, but I don't think they're as sophisticated as we are. I don't think they break these products down like we do. I've been working with these products since 1996, whether it is a structure or as one of the first traders of CBOs.
What's a CBO?
CBO. So CBO, and you got to look at that middle letter. So it's a collateralized bond obligation. The first deals that were put together with high yield bonds back in, we'll call it the mid 90s. We also had something going on in the mid 90s where you had telecom companies, right? And in the high yield market, there was biggest issuer were telecom companies, long distance phone. Okay, talk about that. Remember those long distance phone companies? Well, you had a telecom crisis back in, we'll call it 99 to 2002. And all these CBOs that were created and had all these telecom bonds, they all got written down. They had some losses, but it was the same thing. I came in, I was one of the first buyers in CBOs, and I was buying stuff at cents on the dollar that were breaching their coverage test. What I did, my first job, when I was buying CBOs was very similar to what I did when I started Hildene. I was buying trust preferreds, because when you have a crisis with an asset that's trading for the first time, you usually can find good opportunities. Where we are now is we trade opportunistically structured products on an unlevered basis, buying residual tranches such as CLO equity, or buying the tranche above it, the double Bs. We're securitizing mortgages. So we buy non-QM mortgages from one of the largest non-bank, or the largest non-bank originator, Cross Country Mortgage. We buy their non-QM, we securitize it, we keep the residual tranche. So we're creating the securitization. But then we created a reinsurance company. And the beautiful thing about this is we're reinsuring fixed indexed annuities. There's a really big company out there called Apollo. They got this thing called Athene, and it's $250 billion. And I'm telling you that I can find really good one-off opportunities. I can't find $250 billion worth of them. Could I find $10 to $15 billion of them? Well, I had a whole bunch of trust preferreds, which I was in Africa in June, and we were in the Serengeti, and I saw the migration. The beginning of the migration, I called my partner Duchamp, and I said, what we're doing the TruPS right now is the great TruPS migration. We're migrating them right into the reinsurance company. And what we're getting is great funding on them, non-mark-to-market funding for 10 years. These are going to be around anywhere, these trust preferreds, anywhere from 8 to 15 years.
When you say great financing, you mean you're paying off the liability with a very wide credit spread, and you're okay, no, explain what you mean then.
What does an insurance company do? So an insurance company, we'll call it with an annuity. An annuity is a savings account with a tax advantage. And because you had all of these people who had baby boomers had 401ks, and you either have to cash out of your 401k or you can roll it into an annuity. And a lot of people buy annuities. They buy it for their mom. Here, mom, I'm going to buy you something, take care of you. And basically, we come in and we say, all right, we will reinsure this. So the person that originates it, we found somebody who's a very good originator, and they didn't understand the assets and need a little help, and we came in and helped them, but we invested with it.
And who is that originator?
It's an originator called Silac. Okay. And basically, Silac very, very good at originating. They create great structures in these annuities. But let's just say it's a 10-year annuity. And they say, all right, Brett, you have, to give us 6% for 10 years. And they say, here's $1 billion of annuities. And I put up $100 million. Okay. And they say, all right, anything over 6%, you keep. So let's make the math easy, and we'll say that $1 billion, I got to give them back $2 billion, right? I got to give them back $2 billion in 10 years. Well, I just put in all these trust preferreds. I put in all these other assets that I really, really like. And my net interest margin, let's just say, is 4.5. And I got 10 times leverage. So I'm going to make 45%. And I know these assets well. The one thing about these assets is if you hold them in monthly liquidity, yearly liquidity, either you got to get good financing on them, and that's hard to do. Now I have great financing on them. I have 10 times leverage at 6%. You can't get any better than that. And a lot of people are doing this, but you know what a lot of people are doing? It's most of the private equity firms, and they're all going out and they're issuing this private credit and they're putting it into it. And I don't know. I mean, I'm not a single name credit person, but I just look at things when they get a little too incestuous. And I'm saying there's a lot of private credit being issued out there. And the one thing I do know is that if you go out and you raise money and you don't find something you like, you're not going to give the money back. Like if you're a bank and you have to put money to work, you can go buy a security, you can go buy a treasury. But if you've raised a private credit fund and you can't find something, you're going to reach for something. And that's where you're going to have problems. I don't think there's going to be massive problems. But what I do know is that, at 10 to $15 billion finding those assets over the next 5 years, I know I can find some of the best stuff there is out there. And I've already got a huge, huge jump start because all those TruPS that I had that have all that optionality have moved in. And all these other CLOs that we have great, looks into and understand, and non-QM mortgages. I mean, that's where we're very different. That's where we're very different.
A lot of private equity firms, private credit firms, in some way are following the Warren Buffett Geico model of own an insurance company and then use the very cheap liabilities, the cheap, not deposits because it's not a bank, but the cheap money to fund other securities. I mean, that's the whole game of insurance. And so go ahead.
Kind of. Warren Buffett's very different. Warren Buffett has built so much surplus that he just buys stocks. Okay, for what we're doing is we have to finance these things. So we have to buy certain assets that fit certain rating qualities, certain criteria. We have to have a diversified pool. But in many ways, it's a lot like a CDO. I used to call it when we first were looking at it, it's like a CDO on steroids. Because we understand structured products so well, we were really able to get our arms around this. The members of Hildene are the largest investor in this, okay? And I'd rather be nowhere else than this because I believe in these assets. I believe in me. I believe in my team. And getting this type of, non-mark-to-market funding that's long-term, couldn't ask for anything better. And by the time it's done, I'm probably going to be set to retire because I ain't young.
Hello, everyone. Permissionless 3 is coming to Salt Lake City on October 9th. The event for crypto natives is heading west, and we are bringing the biggest names in crypto together for an insane, can't-miss event. Hear from more than 200 industry titans, including Balaji, Mike Novogratz, and Dan Tapiero. The conversations at Permissionless will be covering the hottest themes in crypto, including modularity, restaking, the Bitcoin and Solana ecosystems, AI and crypto, rollups and L2s, institutional adoption, and of course, the November election that will be right around the corner. We couldn't be more excited about this event. Get your ticket today and make sure I get some bragging rights by using my code FG10 to get 10% off. That's FG10. Stands for Forward Guidance. I want to see you there. Do it. It's going to be at one of the most beautiful places in the United States, and everyone's going to be there. Vance Spencer's going to be there. Jim Bianco's going to be there. Jan Van Eyck's going to be there. So what are you waiting for? Get your tickets now by clicking the link in the description and use code FG10. Back to the episode. So when you said Hildene is the largest player in this asset class, which is CDO on steroids, you're referring to trust preferred CDOs.
No. Hildene is the largest player in a very tiny market called trust preferred CDOs, which is a great asset class because there's not that many people who play in it. It's not marked that much. Not so many people analyze it. So it's just it still trades much wider. If you went out and traded, it trade much wider. And you have to understand something. Like most of the time when we were buying this, we were buying little bite sizes. Most funds are set up, or most insurance companies, or most banks are set up where it's like, okay, I have to go set up a platform. If I'm going to set up a platform to go buy trust preferred CDOs and Hildene owns them all and they have the advantage and they're going to get the looks, I'm not going to ever be able to get anything. And what also happened was when people would come into this market, they'd come in and then all of a sudden they'd be able to buy a couple things because there'd be like some large auctions, but then they couldn't get any more. And they're like, okay, what am I doing with this stuff? Like, I might as well just get rid of it because it's run up in value. So what I'm saying is that we've created a very, very small reinsurance company. We're looking to be $10 to $15 billion. Apollo's $250 billion. How selective can they be? If they're looking at structured products, and I'm telling you, there are these small little niche opportunities that we always find, and those exist. But I can't find, $50 billion of them. Right? That's where there is a huge law of diminishing returns. Okay. The larger you get in structured products, the more your returns are going to go down because you can't find those great opportunities. What we are is we are master odd lotters, right? We're buying small little pieces over time. And if it's a fund that we have and it's like been around for a long time, And all of a sudden we said, we want to switch and go into, we're not in CLOs, but we want to go get into CLOs. We are in CLOs, but we said, we want to get into them now. You can't just go out and put $100 million to work. It takes time to find these things and source them. Okay. It takes the understanding the market, having the relationships. We partner up probably in structured products.
So you think that the game of having a fund have a reinsurance or an insurance arm, as many private funds do, and as you have you said, a small reinsurance fund, that is CDOs on steroids.
Here's what I would say. We have a reinsurance company. Other people set up reinsurance or insurance companies. Okay. These are private equity firms, KKR, Apollo, Blackstone. They all got them. And they're funding most of their stuff that they're originating. Security Benefits, another one. They're going out, they're funding stuff. When I say it's a CDO on steroids, what it is we're buying debt, which is what you do in a CDO. Okay. We have rules that we have to adhere to, whether rules from an insurance regulator, whether rules from the counterparty that we're reinsuring, and we have to meet these certain rules. We have to meet rating requirements. We have to match up the duration of the assets and the callability. Many people are not looking at the callability of the assets. If you go out and you buy corporate bonds, okay, to reinsure an annuity, and let's just say you did that when the 10-year was at, we'll call it close to 5%, okay, and you're buying corporate bonds, when all of a sudden you're buying these corporate bonds at 7.5%, you're reinsuring an annuity, let's just say at 5%, and all of a sudden these corporate bonds go down in price, people are going to call away those corporate bonds. But you've got a liability outstanding, right? That liability hasn't changed. We have assets that we don't feel have callability. They don't have call risk. So in a CDO, or a CLO, you're buying loans, you're working within these rules, and you're trying to maximize the way that you put this together within those rules. It's a very similar concept.
Okay, thank you for explaining that. But isn't it the case that at least some CLOs can pay down their debt early, not because the risk-free rate follows the 10-year, but because credit spreads narrow? Like I know that CLOs have done that this year. Yeah.
No, you're absolutely right. My point is you have just gone and sold a liability. You have sold an annuity at 6%. You were investing, let's just say, at 8%. Okay. The assets that you were investing at 8% went down to 5% and got called away. You now have to buy assets at 5%. You can't pay off that liability. That liability can't be paid off by you, but it can be called by the person at a penalty, person who bought it. And that's where the callability risk really comes into it. And I think that's where the way that we look at the world and look at it, just when I say similar to a CDO. In a CDO, you're trying to take advantage of the spread, the net interest margin, the difference between your assets and your liabilities, your cost of funds for your residual. Okay. When I'm buying a trust preferred CDO at 5 cents on the dollar, no one's financing me. Okay. My downside is 5. My upside is pay me all my par, pay me all my interest. That's pretty good. Let's see if it happens. Okay. Mm-hmm. We're out of that world now. That world doesn't exist anymore. Now we have assets that are all performing. They're paying. They're doing well. Banks don't have any problems anymore. We got CLOs. We got all these other things. But now I have term funding. So now I have term funding in there. And what I'm trying to do is take advantage of, we'll call it the 10 times leverage. But I've got assets that are a little bit wider, okay, and I'm finding other assets, and I'm creating other assets. And I'm saying I can create better assets at a wider spread where I hold this and get that net interest margin. And that's a CDO, we'll call it, that's a CDO on steroids. Super betas.
Okay.
We got a lot of different words. I mean, we're just structured products geeks that sit around all day long and talk about structured products. And it's not that exciting. Like there's no college kid sitting there like, gee, I really want to I could go work at Google or I could go look at structured products. We're losing out to Google, but that's okay. That's okay.
That's okay. Yeah. I mean, probably a few college kids listening to this now who, if they're listening to this, they must be interested in it. Yeah. I mean, the world of the structured credit has shrunk since, 2007, it was an absolutely huge CDO market, right?
Let's just talk about that for a second. The CLO market is boomed. Okay. It's over $1 trillion. That's broadly syndicated loans. That's huge. That's never going away. And it's also more efficient. There's more smart people in there. And I'm just saying, there used to be times where you could just find things and just shake your head and be like, how do people? There are smart people in the CLO market. It's big. It's not going anywhere. Then you have the private credit, okay? The private CLO, the middle market CLO market. That's very, very big. So people are securitizing these private credit loans and in many instances taking the mezzanine tranches and putting them into the CDOs and the senior funding is being sold to a bank. That's much bigger than it was. What you had pre-crisis is, look, you had so many conflicts of interest. You were creating assets that were destined to fail. People were buying houses with no money down. The only way you could do that is you put them into a CDO. What I will tell you is the one thing which I don't think a lot of people talk about is, 10 years before, most of the banks were private. And within that 10-year span, they went public. And if you were at Solomon Brothers and you were a partner, you were looking at what the other people were doing. And if you didn't like it, you spoke up. So if you were in the corporate bond desk and you looked over the mortgage desk and you said, why are you guys buying all these subprime bonds? I don't like it. Get out of them. That would happen. What changed was that when they became public companies, people were getting compensated on short-term, results. So how much can I produce in 1 year? Oh, well, I have to hold all the senior bonds. Well, those have no risk for them. Oh, I need to create more. I'm going to put this person in business and I'm going to sell my stuff to him. I mean, that's where the conflicts really happen. And that's where some of the problems occur. You can talk about never should have happened. Yeah, you're right. Never should have happened. Did happen, but it happened because there was a place for them to go and to be, we'll call it securitized. That gave the securitization market a really, really bad name for a while. There are more and more assets being securitized, whether they're restaurants, okay, we're securitizing their receivables, whether it's subprime auto, mid-prime auto securitizations, whether it's credit cards, they've been around for a long time. So there's many, many different asset classes that are being securitized. And it's a great way to fund these assets. And it also makes things cheaper because you're funding them in a way where, now you can create a better source of funding. The trust preferreds that were issued would have come so much wider if you had to go out and sell $10 million of a trust preferred into the marketplace. But when you're selling them into a securitization, and now you're selling an A-rated bond, whether it was right or wrong, or whether it got written down, that's okay. It was a long journey. I said, it's a long journey. I'll buy it at 5 and see where it takes me. It's been a great ride. But yeah, I get it. When they were trading at 5, a lot of people weren't excited to keep.
A benefit of securitization is diversification. In the same way the S&P 500 owns 500 companies, and it's not just dependent upon one of them, although it has become less diversified as the percentage of the Magnificent Seven, Apple has grown, and it is dominated by those large names. In the same way, a subprime mortgage bond or a CDO constructed of subprime mortgage bond, you had a subprime mortgage in Florida, you had a subprime mortgage in Nevada, you had a subprime mortgage in California. And it's my understanding that the historical models said that those were not very correlated, that, the real estate markets are regional. And if there's a real estate crisis or a real estate downturn in Florida, California holds up and it doesn't affect everything. Of course, if the underlying thing that's fueling the real estate market is.
So you're basically saying that you have historical data when people put 20% down. My father was a merchant marine captain. He was a sea captain, the first Jefferson, and hasn't gone to sea. So when the housing crisis was going on, he said, can you explain to me what's going on? I said, yes, people are buying houses with no money down. And he looked at me, he was shocked. And I said, when I bought the first house, I had to go in with all my material, put my tie on, put my suit on, went in, I put all my money. I took all my money I had and put 25% down. So you're doing an analysis on an asset class where people had put a large, made a large investment. Your $1 million house, you're putting $200,000 down, okay? And that $200,000 means a lot to you. And you're not just going to walk away from it. And you're taking that data and you're comparing it to somebody who put zero money down, who had no real tie financially to that asset. And you're saying we should use that data. Was that a good exercise? I would draw the comparison as it's like saying, all right, we're going to analyze driving statistics, okay? And we're going to analyze people who are driving, okay, regularly, and then people who are driving blindfold. Would that be a good way to analyze how people are going to drive when they're blindfolded? Using that historical data? No. So the diversification issue, yes, you were talking about diversification. But if everybody's putting zero money down and you have inflated prices, and the only way that they can get out of them is to sell them to the next person, but all of a sudden that market dries up, there is no diversification. Okay. There is no diversification. And you can argue, like, well, when you're putting all these different banks into, securitization, yeah, historically, certain parts of the country, they would have different problems than other parts of the country. Okay. But when you have a banking crisis that's driven by a mortgage crisis, and a lot of these banks were aggressive, well, the diversification doesn't mean anything. It goes back to telecom. Well, you're supposed to have diversification, and you really weren't supposed to have, we'll call it more than 5% in any one industry. How come there were 40% of CBOs had telecom bonds in there? They just called them different things. They call it long distance carrier, long distance provider, long distance infrastructure. So they were just calling them all different things. But guess what? When cell phones came around and long distance phone companies went out of business and had no recovery value, that wasn't good. So yeah, I mean, mistakes have been made. I would say where we are in securitization market today, I'd say the CLO market is very, very smart, because the people who are buying it are going to come in and they're going to question, and they're going to pass. They got a lot of things to look at. There are different nuances with the CLO market, which we look at and say, maybe that person's too big because you have to go get the assets, different things like that. When we're buying non-QM mortgages and someone's putting 30% down, okay, they're putting 30% down. Are they going to get up and walk away from that home? And even if they do, are we going to have a 30% drop in the value of that house? So that's where we look at things and we say, yeah, we're okay with that risk. But don't get me wrong. Historically, Wall Street has made some of the greatest blunders of all time. And yeah, I don't mind capitalizing on them. It's okay. There's nothing wrong with that.
Right. And the key point, just for our audience, is that if you invest in these structures products, you really are short the correlation. You want them to be diversified, and if the implied correlation is that they won't be that correlated, but they actually are correlated, that's where they get in trouble, where the mortgages go bad in Florida and California. And likewise, from your favorite Philly Fed paper from 2011, they said that and correct me if this is wrong, if this is something else that they got wrong, that
I haven't read it in 10 years. I haven't read it in 10 years. So
okay. Well, just that they said that the trust preferred securities, in the late 1990s and in early 2000s, that they divided into 5 regions, and that they assumed that the correlation between the banks who had the debt in the regions was 0. So literally, if you had a bank on 2 banks across the street from each other, but in the middle was a dividing line, they would assume that they had a 0 correlation of default. So was that a similar issue?
Not really, because I think you could look at it and say, if you have small community banks in an area, and let's just say it's you have a factory in that town, right? And that factory goes out of business. Okay, that's going to affect that town. That's a microeconomic variable that is occurring. You're basically saying that the correlation or diversification, it is important. It's important to have. But if your assets are good, your assets are good, right? That's really what it comes down to. If you're putting in really, really bad assets, okay, it doesn't matter if they're all diversified or not diversified, right? And what happened with subprime mortgages was, it just, like, there was no loyalty to that mortgage. Like, when I say loyalty, I mean, no one's going to fight to keep that house. People keep handing their keys and walking away. In regards to diversification amongst banks, we had a banking crisis. I'm not arguing we didn't have a banking crisis. The problem I have with that paper was he was saying that everyone is going to lose on this. And I'm watching them all pay off. Now, it was a bumpy road, okay? It was a long, bumpy road. But I've got them where they're paying off. He's saying the seniors weren't going to make it. So how we got to this point, like, I didn't create these things. I didn't make it in the new issue market. I came in afterwards and I said, what do I got here? And, it's like, that's really what you look at if you're buying, a distressed situation. You don't care, like, how did we get here? I don't really care how we got here. We got a problem. Is it worth me coming in to buy this? Is it going to be worth my time? So, I mean, I guess going back to it is The securitization market is smarter because we are more regulated. There are more people looking at it. There's more things that you have to do. There's more forms of securitization, whether it be solar and different types of receivables, music royalties. I don't really get into all those things. Okay. But things like, mortgages were 30% down, those interest me. CLO market's large, but we can still find good opportunities. Obviously, the bank one works. There are some real estate type products that we look at. We do not play in CMBS because it's a very, very large, crowded market. And I'd rather be in some place where there's, it's off the run, we'll say.
What are the risks you see in the various markets that you participate in now? And do they have a similar issue of assuming zero correlations? And I guess, just to make clear what I'm asking is there's an argument that a lot of people now are back testing, private credit has performed, it has generated equity-like returns with bond-like risk. And the argument is like, yes, in 2000, the private credit market, according to a study from the Fed, you could disagree, was $40 billion. Now it's $1.7 trillion. JP Morgan says if you include leverage, it's closer to $3 trillion. But basically, has the market grown so large that back tests no longer make sense because now marginal credit creation is happening at private credit and it's not just some niche part of the market like it was?
Well, there's a few things here. One, we talked about subprime, the difference between subprime and the mortgages we're buying today. And a lot of it had to be with the commitment, right? The amount of money that you have in, which means that you're gonna make a better selection. You're gonna work and fight to make sure that works. So I'm gonna touch on private credit, but we're not involved directly in private credit. Okay, when you say we are in private credit, our private credit are non-QM mortgages that were securitized. Do we look at middle market and private credit securitizations? Yes, we do. Do we go through, and one of the things we look at is of the debt of the private credit of the originators, how much equity do they own, right? Because a lot of times they own these companies, or private equity companies, so they're buying equity, and now they can finance these companies with this debt. But they own the equity, right? Now they're issuing the debt, and they're owning that debt, but then they're securitizing it, and they're getting other people involved. That's an indicator that, okay, there's some people here, and they actually have some skin in the game. They have a rational reason to work. If you ever listen to Michael Milken, and he talked about when he started looking for people who wanted to issue, junk bonds, high yield bonds, he looked for people who had really good ideas, but more importantly, they had everything they had in these businesses, and they would fight for these businesses. And that's a big difference between a person buying a house with no money down. Now, red flags for businesses, for things that we're investing in right now. CLO market's a big market. They talked a lot about, wow, we're looking at a crisis that's going to occur. What COVID did was anybody who was a bad company got cleaned out in COVID. So if you believe that, you're going to have X amount of defaults over a certain period of time, COVID kind of front loaded it. So maybe some of those, we should be having more defaults right now, but they were taken out in COVID. The things that I'm looking at, if you think about somebody who's buying a home right now, I'm buying a non-QM mortgage. That's a self-employed person, right? Can't be selling that to Fannie and Freddie. All right, you gotta go get a mortgage today? All right, you've got to go get an appraisal. The appraisal rules have changed. Appraisers just can't go and, whatever you paid for is good. Appraisers are very, very highly scrutinized, and they will take their licenses away. You have to sign more documents and authentications and everything else there is. Okay, they are not allowing people to misrepresent when they're going out and they're getting a loan, because they're saying that could lead to a banking crisis. And who owns the super senior risk of all banks? The United States government.
Through Fannie Mae, yeah.
Yeah, no. Well, if you go to a bank, you don't have to go to Fannie and Freddie. If you go to a bank and you get a loan from a bank and that bank fails, the FDIC is on it.
Oh, sure. That's what you meant the U.S. government. Sure. Yeah.
That's the U.S. government. So I think that some securitization markets are getting into, some of these newer ones, I kind of want to see them develop before we jump into them. Now, the commercial real estate market, we've got to change. We've got to change in demographics. Okay, I live in North Carolina now. I moved from Connecticut to North Carolina. There is more development and growth down here than I've ever seen. I moved here because nice place to live, nice place to have my kids go to school, and I don't sit in traffic anymore. And if you look at places like Nashville and Austin and Raleigh, North Carolina, Salt Lake City, these are places that are booming, but the people are leaving other places. And then you ask yourself, like, What are you going to do with all that commercial real estate? There's a mall in Stamford, Connecticut that they couldn't find anybody, so they play pickleball in there now. That's what they do. They play indoor pickleball in the winter. Okay, you've got a problem with some of these assumptions. Let's just say that went on in the CMBS market. I'm not saying it's all going to go bad, but it's a market which we're not really directly involved with.
Got it. So yeah. So when I introduced you, I said Hildene Capital Management, structured credit, opportunistic, private credit. That's just from your website. But the private credit, most of the private credit you're involved with is non-qualifying mortgages, which is, so it's not like 95% of the people who go on Bloomberg and talk about the golden age of private credit. That is middle market direct lending where they're raising a fund to lend to companies. And sometimes, they say they're not using leverage, but often they are using leverage from the banks. That's not your world. So I guess, okay. So I'm going to ask you about what your world is.
And I say, guys, this is not private credit. And they're like, well, it's private consumer credit. And I'm like, oh, we do non-QM mortgages and we do multifamily. So we're involved with a program through Freddie Mac, and it's basically called the Freddie SPL program. And Freddie likes to go out and issue a 70 loan to value, but then they sell off that bottom 10%. It's kind of like a club. There are 4 people in it, and you're able to buy this bottom piece. You can go through and do your work on it. It's a pretty interesting thing. But when I say private credit to us, we may be buying a private credit securitization.
Yes, a CLO where it's a structure where the assets are private credit, middle market loans, but the you're buying the liabilities of that structure.
Pretty much everything we own is either in a securitization, or we're creating a securitization, or it's a broken securitization, or maybe it's something that we bought out of a securitization and there was nowhere to go with it. Like I just sold it to Trust Preferred from this bank in California that we had for 5 years, and it was just one of these banks that lingered around. And somebody came to me, they were buying the bank. I said, "Here, I'll sell it to you." Didn't make money on it, but that was one to hold too long. One of the funny things about what we do, I was telling someone about this the other day, is that we don't really deal with people. Like when you buy a securitization, you get an indenture. Here are the rules. So you can never have like a CEO who's going to pivot, and you don't have someone who can steal from you because all the money goes to the trustee. Now people will try to steal from you in other ways, and the trustee might not know where to send the money, which has happened. But you see what I mean? Like when you go out and you invest in a company, you gotta deal with that person. Okay, and sure, there might be a CLO manager, but for the most part, they're not going to do anything that's going to jeopardize their franchise. So in some ways, it's a really, really nice thing, but it's a really different thing. Because most of the people who are in private credit, they're talking about this company, this EBITDA, and this, the way it is, and its peers. And we're looking at it as like, here's a pool of assets. Okay, let's take a CLO. And I can go on and get an opinion from 12 people on all these assets because people mark them and trade them. And I'm not really looking at each and every one of them and doing a full deep dive on them. I'm saying, what are the ones that are going to get me into trouble? Because I'm not in the business of looking at one credit unless it's a problem within a securitization, if that makes sense. I hope that makes sense.
Everything makes sense except for the last part.
So you buy a CLO, there's 100 loans in there, right? Let's just say you buy a CLO, there's 100 loans in there. I'm going to say, let's just say you got 2 CLOs, okay? One of them, all of the loans are trading at 95 cents on the dollar, okay? And you say to yourself, like, okay, 95 cents on the dollar, that's not bad, but okay, 95 is telling me that they're probably going to be okay, right? Then you have a CLO, another one, and 90% of the loans are trading at par, and 10% are trading at 50. And that gets me to 95. If my math is correct, I think it is. So now you got 2 CLOs, both with average prices of 95, both with very, very different profiles. The second one, okay, I need to understand what those loans are trading at 50, what they really, really are. The one that's at 95, okay, and this is a kind of a real extreme example, like they're trading at 95. 95 doesn't tell me that they're going to, they're going to go bad. It's not something that's telling me like we're going to have a lot of problems here. But I still got to understand that. I got to say, how much how much loss can I take before I really, really get impaired? One is telling me that there could be a direct loss component in there. And the other one is saying, how much loss could I incur before I have problems? So those are different ways of looking at 2 similar structures.
That makes sense. So yeah, so the CEOs of the large private credit firms, when they go on Bloomberg, they're trying to sell their cooking, and you are not cooking what they're cooking, but you are eating the cooking through the securitization market. I know it's a bleaker metaphor, but through the CLO market. And so, but isn't it true that the CLO market used to be the BSL, broadly syndicated loan market, that the private credit part of the CLO market has really grown? And just for our audience, broadly syndicated loan is JP Morgan has a loan, it creates a loan, and then it syndicates that loan to many, many, many other buyers. Middle market CLO is Ares, I think the largest private credit company. They have a fund and they create a loan, and maybe they either do it themselves, so that it has one issuer, or it has three issuers, or two or three issuers through a so-called club deal. So it's the people who issue the loan and own the loan is way less diversified.
Well, let's talk about that. So JP Morgan would be finding a company that's, either public or private, and they go to JP Morgan and they say, here, I want to issue $500 million of debt. And their bankers look at it. They say, okay, we think you're single B. We think CLO, people will buy this. Maybe that company has some private equity investment, but maybe it's all owned by, the people who own the company. Ares goes out and invests in a company. Okay. Then they say, I need to go issue debt. Why won't I go to JP Morgan? I'm going to go issue debt, and I'm going to take that debt and I'm going to put it in my insurance company. Okay. I'm going to put it in my insurance company, or I'm going to securitize it, and I'm going to take the mezzanine part of it and put it in my insurance company.
We know that terms such as private credit can be a little bit misleading, but just from Ares' website, and I looked at it recently, so their AUM is $450 billion, and most of their AUM is in credit. So I thought they're mostly a credit shop, not a private equity shop.
Okay, sure. They find a company that, somebody issued, they have, instead of going to JP Morgan, that company, they go to Ares. Ares says, I'll give you better terms. I don't want to be in the broadly syndicated market. I mean, there's a lot of different reasons. It comes down to economics. That's one reason, but I'm telling you, a lot of them is that a lot of these guys are invested in these, and it's very, very incestuous. But on the flip side for private credit, if you own the equity of the company, you've issued the debt, you put it in your securitization, that company has problems. This is where the distress market has changed dramatically. It used to be there was a distress market, people would run around and buy all the debt in the secondary market. Now, a lot of times these things are restructured, because if I own the equity already, I'm just going to go in, I'm going to give you bailout money, which basically means I'm going to charge you a very excessive amount. I'm going to own more of your company, but it's not going to really, that problem's not going to, come to light. That's not bad. That's not good. Look, there's a lot of money in the system. There's a lot of money in the system. Okay. And it's not coming from banks either. But that's really where we are with private credit and the change or the phenomenon with it. I'm not saying it's all going to go bad. It's just not what we do, but we look at the securitization aspect of it. Like I said, we do a few different things. We buy non-QM mortgages and we buy multifamily. We securitize those. So that's another thing that we're doing there. Or we're buying consumer assets and we're securitizing them. Or we're putting things that, are either rated, or we're getting them rated, or repackaging them and putting them into our reinsurance company. And we have an asset management business, which is really a lot of these trust preferred CDOs and other asset classes called TruPS CDOs, where we bought the managerial rights. And it's really more like mortgage servicing. But we find a lot of cool things, but you just don't find them all at once. We don't have a lot of turnover of our assets. Because if you buy something cheap enough, you're going to ride it out, or then you're going to get financing on it. So that's really what we're doing.
And what was it? You said it very quickly. The other market, the blank TruPS market. What was that? The other market?
TruPS CDO. So back when 2005 to 2007, when anybody with a pulse could get financing in the CDO market, they created this market where there were 16 securitizations, and they were called REIT TruPS. They're basically real estate. And there were three types of real estate assets that went in there. There were big name real estate, companies. Okay, KKR, Colonial, or some of the other ones in there. A couple other really big ones are just not coming to mind. Then you had some mid-tier, one-off type of projects. And some of those have worked out and some of those haven't. Then you had securitization tranches, which didn't work out usually, and little developments, like speculative.
What do you mean a securitization tranche? A securitization of a CDO squared?
No, they were just putting in like a one or two mezz bonds from these deals. They have blown up. These REIT TruPS CDOs, let's just say there was because I'll tell you an exact one. There was A down to F, A, B, C, D, E, F. Okay, and then equity, right? Nothing under the B is ever going to receive money. Okay. And let's just say we own the A, we own the B. Well, when a deal goes into an event of default, you can liquidate the deal as to what the indenture says. And most of these deals, it said you can't liquidate these deals unless you get 66 and 2/3 of every tranche to vote yes. And we got friends. So we sat down one day with a couple of our friends who have these things and said, what do you got? And it was kind of like putting all your baseball cards out there, and we're putting them all out there. And then we're like, wow, we only need these two, we only need to pick up some more of these bonds, and then we can liquidate the deal. So we may have been paying, like, let's just say 1 cent on the dollar for a bond that's going to pay us zero. But then we were buying the senior bonds at 55 cents on the dollar and they paid us 100, and they were much bigger. And we did that twice. Got a couple more. We're looking at doing that, but it's a lot of work. It takes time. That's just being in this market and thinking about things and finding things and taking time and doing it. But in the REIT truck market, we manage these deals. And when I say manage, there's really no management to it. It's like mortgage servicing rights. It's You're doing administrative work. And if there's a problem, then you come in and you deal with the problem.
You cash the checks, and if the checks, you're not getting the checks, then you deal with that.
Then we deal with that. That's a good way to look at it. Yeah.
Okay. Thank you for explaining that. And so, Brett, I'm really glad that we've had this conversation because the TruPS CDO market is so niche. But just to talk about something that's niche, but slightly less niche, the private credit CLO market, collateralized loan obligation, or the middle market, that's also what it's referred to. Do you think there are risks in that market? Because, I mean, admittedly, I heard this from a high yield guy, but in terms of credit risk, it generally is like people think of high yield bonds as junk bonds and as risky bonds. And of course they are relative to investment grade, but generally the high yield market has actually shrunk because it's been refinanced by the leveraged loan market, which is slightly riskier. And then the leveraged loan market, the broadly syndicated BSL market. Then there's the private credit, which is even riskier. So,
I said something, a couple minutes ago. So first thing you said was, these are small niche markets. They're not small markets. Okay. So the private credit market is not small. Middle
I know.
Is not small. When they do a lot of these securitizations, a lot of them never, they're already placed. So the equity is being taken, let's just say, by the people who own the loans. Let's just say it's one person doing the securitization. They're probably going to take the residual tranche because they're in the business of getting good financing and getting term financing. That's it. A bank's going to take the seniors. The bonds in the middle will probably go to some insurance company. And that insurance company might be part of the private credit market or the private equity market or the market in general. Like Ares, they got an insurance company. Apollo's got an insurance company. Blackstone's got an insurance company. KKR's got an insurance company. So they're all taking that also, or they're parceling that out to other people. I don't think it trades as much as the broadly syndicated market. I think that might change. Now it comes back down to risk. Like I said before, if you're a behemoth and you've already invested in that company in the equity, and now all of a sudden they got problems with the debt, well, you might just wipe out the equity and be like, all right, I'm going to give you some bailout money. So I don't think it's as clear as that. I think it used to be a lot different when, there wasn't, like, I'm not saying that the original CLO market, you were going to these companies, you were finding it, you were selling it to the deal, right? Maybe that company wouldn't have ever, that high yield bond or that leverage loan would never have sold in the marketplace unless there was a securitization bid for it. I think those days are long gone. Just like there was never going to be a bid for a subprime mortgage unless there was a securitization market, which was this giant incestuous market, because then they created the CDO squared market.
Mm-hmm.
I don't think we're there. Okay. I think that we did a great job. When I say that, all financial people involved, everyone was involved in some way, shape, or form. Okay. And did a great job almost blowing up the world and, just getting rid of the whole capital markets. We made it through. And we've learned a lot of lessons. I don't think we've forgotten those lessons. Like I said, if you look at the mortgage market, and you look at the bank market, they certainly haven't forgotten this. I don't think we're at anywhere remotely close to anything like 2008. Well, we're going to see that while I'm still on this earth.
Got it. Yeah. When it comes to the mortgage market, I just read reports and seen charts of the FICO scores of the borrowers. And yeah, it is a factual assertion, a factual statement to say that credit standards have tightened enormously, meaning that people are who, your average person who gets a mortgage is more likely to pay it back than, let's say, in 2005 through 2007. Okay, and so you don't think we're anywhere close with the private credit CLO market. Where are you viewing the risk rewards? Let's say you're not even thinking about a crisis, but the risk reward of, I know CLO spreads have tightened dramatically.
Where I see the greatest risk reward for me, Brett Jefferson, is I've got a lot of assets which are in my reinsurance company. I can find other assets. We're in the business now of sourcing and finding other assets. We're not growing at such a rapid pace. We had a great ramp up period with the assets that we had to get it going there. I think that our net interest margin is going to be phenomenal. And to me, it's the coolest thing that I've ever seen. And like I said, this is probably going to be the last thing that I do. Like when this thing ends, I'm probably going to say, or it doesn't end. It could go on forever. But I will say this is that hedge fund managers and athletes, their careers usually don't end in a positive way. And I've told everyone there, like, I'm going out on my way. And for many ways, I have a very, very great, respect and fear and understanding of risk. Okay. And I understand that risk and I understand what it is. And I don't just go out and jump into this market because all the cool kids are doing it, or jump into a different market because I can make money doing it. Right now, I've done, very well in myself, and I'm saying, I'm going to bet on me, and I'm going to bet on the products that we have. But the reinsurance and the non-QM market, as long as we have the ability to buy from cross-country mortgage, we have a huge competitive advantage. As long as we have the ability to get reinsurance, annuity liabilities, and we have assets that we can buy that we really understand and we really, really like, and we like them because guess what? We're not a subprime issuer. We're a 50 loan to value issuer. Think of it that way. We got a lot in here. Okay. We're really, really watching this. So yeah, what am I excited about? I'm excited about that. Okay. I don't look and say, well, I like Bitcoin because I don't like Bitcoin. And I don't sit there and say like, gee, I think the stock market's going to do this. I think that's actually really, really hard. Like I buy a bond and you're going to pay me, or we're going to go to a courtroom and we're going to go argue about how we're going to get out of this thing. And that's a lot easier. So that's what I like. I like what I've got going on. And it was a lot of work to get there. But I'm very excited about it. And I got a great team that was working with me, and they're excited about it. And we built this thing out. And let me tell you, a lot of people want to build an annuity reinsurer. A lot of people. We got an office in the Cayman Islands. We're licensed in the Cayman Islands. We've got a forward flow of stuff. And did we have some luck? Yeah, we did. But we found it. We built it. And, who knows? Maybe we'll be originating our own annuity sometime soon. We'll have to see.
Very interesting stuff. And when you said when this thing ends, presumably because you were thinking about retiring, and I understand that, but I don't know if you brand your reinsurance arm, but I know a lot of people brand the reinsurance arm or insurance arm or other things as permanent capital. What does that phrase mean to you? And do you agree with? Do you think it's an accurate phrase?
My capital is permanent. What I've said to the investors, I said we will take our excess. So you build up excess, and as Mr. Buffett went out and bought things, and I will either pay a dividend or I will do a tender for that. I don't plan on going anywhere. We have some people who have expressed that they're in it as long as I am. So is it permanent capital? It's permanent capital for me. I think it's permanent capital for a couple other folks. I think there's a lot of folks that are still looking at us because we don't really need that much more in the way of capital to get where we want to be. So, is it permanent? No, because I'm a man of my word. And I said, I will do these tenders for you. But if I have excess and I'm just buying the shares with the excess, then it's just, we're buying them out, the existing shareholders. So that's just one way to think of it.
As you know, many economists, many pundits, many financial experts have predicted a recession going back to late 2021 or 2022. And that recession so far has yet materialized. Because of that, and because of rising interest rates, the collateralized loan obligation world and the instruments that have credit risk but have almost zero duration risk, interest rate risk, have performed very well and have been the hottest part of the fixed income world. Whereas treasuries and agency mortgage-backed securities has been a horrible place, and there's been lots of losses, hundreds of billions of dollars worth of losses, perhaps trillions. I don't know. But how do you think the collateralized loan world will handle a recession?
anytime there's a recession, you're going to have credit losses. Your underlying assets are non-investment grade. So you're going to have losses. As I said before, if you look at the amount of loss or defaults that you're going to have over a 5-year period, 2020 accelerated those rapidly. And then we kind of bailed out, some of them with government intervention, things like that. Look, here's what I'm going to say about economists. With the exception of one, okay, most of them don't have an original thought. And they go back and they're looking at what happened in 1929 or what happened in 1946 or what happened. We're in a different world right now, okay? We're in a different world. We have an inverted curve, okay? We have an inverted curve, but we have an inverted curve because, people are buying up the short end, okay? And you're looking at this now and you're saying, wait a second. Like, why are we going into a recession? Like, yes, we are going to lower rates. And we accelerated because they said there was inflation. But maybe we don't have to have a recession every 5 years. Maybe it doesn't work like clockwork like that. So I don't necessarily think we're going into a recession. I think that, look, we've got an election year, and usually strange things happen in the market in election years. And I'm not trying to say that things are fixed or rigged or anything else, but speak to a lot of people. They think that, the Feds with their buying patterns are just, fixing the whole economy. So I just take it for what it is. I take it for what it is. Are rates going down right now? Yes, they are going down. Rates are going down. I don't think we're going to have massive losses in the non-investment grade market. Remember, we've had losses before because of technology, because of changing businesses. That can always occur. But, I think the world's getting smarter at realizing that. So, yeah, I'm not overly concerned. And I think, look, the CLO market's going to do fine, okay? It comes down to the losses that are in there. You go into a recession and you have massive amounts of loss that's going to occur, then yes, you will have issues. What are the recoveries is the question. And who are the people backing these companies? That is the real question at hand.
Is it true that the recovery rate has been going down in the CLO market because covenants have been lighter?
There's two ways to look at it. The recovery rates have been going down on the actual assets that default. A lot of these companies never default. They get bailed out, right? So if before you had 10 companies that were defaulting, right, and they were all getting 40 cents on the dollar, okay, great. Well, now you got 10 companies and 5 of them are getting bailed out, but then you've got the other ones that are getting 30 cents on, recovery, whereas the other ones might have gotten more if they had actually come to market. So I don't know if statistics are an interesting thing, and you have to actually look deeper into it. Like, you really have to look at problem credits with sales. When are people getting out of and taking losses in CLOs? So I think there's more there than just, that statement.
I know it's hard to generalize, but I think CLO prices, at least what I tracked in terms of the equity tranches or an index of them or ETF of those, crashed in March 2020 alongside stocks. And then they rallied really well, and they have been paying. And I know that CLOs have been performing really well. What are you seeing right now as we record in the afternoon of September 10th? Are in the CLO market, are prices going up? Are they going down? Or are they staying sideways?
There's been a great rally in the CLO market. The equity returns are a function of where can you issue your liabilities. Your liabilities have been coming in. AAAs have been coming in all along the capital stack, right? This is a funding game, right? So it's not so much as the assets, because you're buying your assets usually at par. They don't really go up more than par. It's what is the funding and then the timing of the funding. So I think that's why the CLO market has been performing well, and it's because of where the funding costs have been happening. Look, it's always about where are you creating CLOs. We play more in the secondary market with CLOs, or we have actually, we'll call it, done some investing in CLO managers, which CLO managers we like. We like CLO managers who are, this is everything they got. They understand how to play the game. They're not part of a bigger, organization, and they just need a little hump because, that little push that we're giving them is going to get them over the hump. And these are guys who are usually very, very, good at trading within the system, working within the system, and we use them to understand problem credits. So we invest in these managers. We agree to take some of their equity. We don't have to hold it, but it's been a very good trade for us.
Equity you're an LP of the CLO or equity of the GP management company?
We are both. We agree to buy a certain amount of equity from their next whatever many deals, and we get a portion of their management stream forever. of their GP. The only form of revenue that they're getting is, management fees from their CLOs. Because we truly look them over, check them out, and we are partners with them, when we see a problem credit, we go to them and talk to them, get their opinion on it. If I go call up somebody in a large CLO shop and be like, can you tell me about this name? They're going to be like, who are you? But we can get information from them. This is an information game, right? This is about getting information, processing information, and making a decision off of that. And when you have all this different information, you have to learn to process it in a certain way. That's why we have a system of processing and come back to the same thing. Looking at the value of the assets, the value of the structure, the value of the option. And that's a simple way in which I started looking at it years ago, and we still do the same thing, but it's tweaked over the years. It's gotten a little bit different. So,
Brett, I'm really glad that you came on and shared your insight about this very niche world. That challenge that you issued to debate the author or authors of that 2011 Fed paper, is that still on the table?
It's always on the table. I'll
Okay.
debate any of them. I got other people I want to debate. So
Who else?
You want to get other people in there? Let me put together a list. Let me put together a list of other people. So yeah,
Sounds good. Okay, I think you're.
Philadelphia Fed has bothered me for a long time because I called them up and I said, I'd like to discuss this with me. They never discussed it with me. And after I prove them wrong, I want them to write me a letter of apology. I'm going to put it on my fridge and I'm going to look at it every day and touch it. Okay.
Okay. There we go. Earlier, you said that there was one economist, all economists with the exception of one. Who is that one economist?
Zervos.
Okay, nice.
Zervos. He does not think that everything that is happening has happened in the past. He actually has an original thought. And I don't listen to him, but I listen to him. But when I listen to people just tell me like, well, this looks like this because it happened this way. Like, yeah, well, you know what? We used to have phones on the walls with very long cords and we paid long distance phone bills then too. So the world's changed. So yeah, you can't always look at things just because it happened one way. It's going to continue that way.
We'll leave it there. Brett Jefferson of Hildene Capital Management. Thank you everyone for watching. And thank you everyone for watching along this journey. This will be my final episode of Forward Guidance, but the future of Forward Guidance is very bright. Felix Javin will be taking over, the current host of the On the Margin podcast. So stay tuned for that, as well as follow my future endeavors, which you'll be hearing about more shortly.
Thank you, Jack.
As you just heard me say, this is one of the final Forward Guidance episodes that I will host. But I've got great news. Felix Javin, current host of the On the Margin podcast, is taking over. Felix is not just a great podcast host, but also a very talented trader as well. And he follows the macroeconomic and central banking news like a hawk, or should I say a dove. I truly am resting easy knowing that the future of Forward Guidance is bright and that I have passed it along onto a worthy successor who has all the skills that I do possess and many that I do not. I truly am very excited to see where Felix takes the show. I also will be returning to the world of financial interviewing quite soon. Follow my new YouTube channel, Monetary Matters, to stay tuned with my upcoming work, which you can expect to see shortly. And lastly, thank you again to everyone who has ever watched my work. I'm very grateful to Blockworks and to Van Eck for taking a bet on me. To you, the audience, who has stuck with me over 400 episodes, from the bottom of my heart, thank you so much for allowing me to do what I love.